Hi guys, welcome to my YouTube channel. So remember I promised that I would find some questions and then try and attempt them on screen for you guys. This is that video. Let's get into it. What is the exam technique in terms of answering corporate governance type questions? So I know, for example, that in the lower levels you might be required, for example, to provide a principle and then an application. So you'd say something to the tune of King requires that the chairperson of the board be an independent non-executive director. And then your application will be, you then go pull what's in the scenario to then write for the examiner to say this is not the case or this is the case, depending on what the question had asked for. So did the question ask for concerns? Did it ask for you to critically evaluate the composition? It's all very, how you answer is dependent on what you've been asked. And so you will then go on to speak about the composition should be your first starting point. So the composition of the actual board should be your starting point. And then the composition of the subcommittees should then be your second line of discussion. And then you can discuss anything else. So what do I mean by the composition of the board? Fine. So King and Companies Act require this of the chairperson of the board. King and Companies Act require this of the composition of the actual board. If there are if there's a mix of skills and diversity that you'd also like to bring in there, you might then bring in that. After you're done with that, you might then want to speak about the actual subcommittees. So the chairperson of this subcommittee should be this person, or rather should be an independent non-executive director, whatever the case is. The composition of this committee should consist of people of this nature. The skill set of this committee should be people of the skill set. So if you think about, for example, the audit committee, it says that they need to have the financial or they need to be financially, literate. So it requires people be financially literate if they're going to sit on that committee. So that is something that you might then discuss. And then you might go into the other stuff, such as, okay, fine, we need to have this many committees at a minimum. So we're supposed to have a remuneration, nomination, audit committee, social and ethics, whatever, depending on the type of question, right? And then your next step should then be to discuss stuff such as other things that are prevalent in the scenario. So if the scenario spoke about, for example, a director's personal financial interest, you might then go into section 75 and discuss those requirements along with the application. If there was a issuing of shares above the authorized share capital, you might then go to the relevant sections that speak to that. But those first ones that I discussed, the composition of the board, the composition of the committee, and all other information related to those structures need to be first, just from an exam technique perspective, always exhaust those first before you then go into whatever else is required. Obviously, the mark allocation is going to guide you. If you are answering an 8-mark question, the examiner might not then be wanting you to go into a discussion about the structures. They might just want you to go straight into whatever section that they've asked you. So if it's a director's personal financial interest, they might just want you to go straight into that, as opposed to all of the other stuff. But I think what I'm going to then do now, question that we're going to do, then we're going to test it against this formula that I've now given you to see if it works every single time. I sourced a university question. This one's from Unisa, and I also found another one from SAICA's ITC. So I want to encourage you to read through the description box, download the questions, make sure that you pause, read through the entire question, and then come back to this video. Now, the whole purpose of this exercise is to see if these questions are going to work with the exam technique I basically gave you. So this question is a question on Angela's Limited. This company was founded in 1988 by Pat Preston. And we also see that his daughter Angela, who's a chef, is actively involved in the business. Angela is an executive director as well as chairperson of the board, right? So this information is important for us because it lets us know, for example, when you're reading with regard to the listing, you already know that they must comply with King, right? And this is even before us seeing the required, what's actually expected of us. But as soon as you see that, you should already be thinking, all right, this company needs to be complying with King. And then with regard to the fact that Angela, who is a founder of Angela's, is an executive director as well as a chairperson of the board, already, gives us some red flags, because we know that Principle 7 says that the chairperson of the board has to be an independent non-executive director. And we see here that Angela is actively involved in the business. So just as an FYI, something that I've noticed that students will do, which is incorrect, is that they will mention a King principle and then mention the King principle in the negative and expect a mark for application. What do I mean by this? So they will say, for example, Angela, or they'll say, Principle 7 of King 4 requires that the chairperson be an independent non-executive director, which is correct. You've earned your first mark or half a mark, depending on which university you come from. Now, the student that I'm talking about will then say, but Angela is not an independent non-executive director. So they're basically stating King in the negative. This is very poor exam technique. And at ITC levels, they're quite strict about this. So they will say that, if you're just going to phrase King in the negative, you don't really deserve the marks. You have not shown any ounce of application. You have not demonstrated that you've even read the scenario. So my advice to you is to use the information in the scenario when applying. So instead of saying, Angela is not an independent non-executive director, it would be more appropriate to say that Angela is actively involved in the business and as an executive director, and therefore does not comply with King. So you're just showing that additional element of application. You're just showing me that you've read the scenario and you're applying the information that is in the scenario. That the FD is Gordon, and Gordon is a CASA. Now this is very important once we get to ethics, so the CPC, which is going to be our next kind of module that we're going to tackle. It says here that Gordon received an email by mistake, and this was an email between Pat, the CEO, who is the co-founder. So Pat, we've now been told that Pat is actually the CEO of the company. Now, what kind of problems does this bring about? So we now have a situation where the CEO is the co-founder of the company. There's not necessarily anything wrong with that. But the issue here might be, or the issue here rather, is the fact that the CEO is related to the chairperson of the board, right? So you have a situation where the chairperson has independence issues. Remember that the point that we did discuss about Angela is the fact that she was an executive director. But with regard to her independence, now we have some issues, because now we're told that actually she's also the daughter of the CEO. So her independence is also in question. So that's something that you'd also need to discuss, to say that, Angela is the daughter of the CEO, which brings into question her independence. Email. Here Angela says to her father, she's realized that she's getting very frustrated with the idea of operating the business as a listed company, right? And then she says, I think we should look after ourselves. Now, this is already a very problematic statement, but let's see what else she says. So she says we need to let Gordon handle all the boring board committee matters by letting him make all the necessary decisions on his own. So, what are the issues here? The issue is that her attitude towards corporate governance is already quite problematic. So she considers all issues relating to board committees to be boring. Now, that says a lot about a person. If they have this type of attitude towards corporate governance, chances are, they might be doing some weird things on the side or whatever the case is. And so she suggests here that they need to let Gordon make all the necessary decisions. Now, is there a issue with this? Potentially, yes, there's definitely an issue because the Companies Act, Section 72 in particular, speaks or rather prohibits this from happening, right? It prohibits the directors from basically abandoning their responsibility and dumping everything on the committees. So the Companies Act essentially recognizes that you have certain responsibilities as a board member and you can't just, dump it onto another person or one person. And another thing about the Companies Act is that, for example, Section 73 speaks about the fact that, board meetings need to be quorate or there must be a quorum in order for decisions to be made. So even if Gordon wanted to do this, he couldn't make decisions on his own because we know that board decisions need to be made by means of a director's resolution. So everything that I've just said is something that you could then write down to say this is the requirement according to King, and this is why it's problematic in this particular instance. So Angela cannot suggest these things because it would be contrary to this specific principle or this specific section within the Companies Act. Angela speaks to the fact that, she's spending excessive time in meetings instead of focusing on her recipe book. Again, tells you a lot about her attitude towards good corporate governance. So this is something that you then write to say, she has a very bad attitude towards corporate governance in the way that she mentions, for example, the fact that the meetings are boring, the fact that she spends excessive time in meetings, and that her interest is basically elsewhere in trying to develop this recipe book. Okay, and then she says we might want to actually consider delisting. And then she says we could dispose of all of these committee requirements as well as the auditors while remaining a public company. So this is actually quite interesting. So she recognizes that being listed creates a compliance burden, right? So they now have to comply with all of these things by virtue of the fact that they're listed. And she then says that, if they were to delist, then they don't have to worry, for example, about committees and they don't have to worry about auditors. This is very problematic and very untrue because if you think about, for example, the Companies Act mentions the fact that if a company is a public interest company, right, they must get audited. So they would have to appoint auditors. That's not something that you can pick and choose. And if a company is a public interest company, they must have an audit committee and they must also have a social and ethics committee. So that is not something that she would be able, or that Angela, as the company, would be able to run away because they have delisted. That is something that they would still need to continue doing. So that's something that you would then discuss to say that, it's concerning that the Companies Act requires this and this and this of public companies, and yet Angela seems to suggest that that would not be the case because then they could dispose of all of their committees and all of their auditors when the Companies Act requires certain things as a minimum. Take a look at the next one. Okay, so here she says, you're aware we have a family property company. They own a couple of the properties that we lease to Angela's. Then he says the auditors, or she says rather, the auditors haven't noticed this. And then she says, why do we have silly accounting rules on disclosing related party transactions? And then she says, she says a whole lot of things. She says it's bad enough that the whole market already knows what I'm worth in terms of my Angela's shares. So now she mentions, before I get into the whole thing about related parties, but she mentions something very interesting here, which links back to our independence discussion for her being a chairperson of the board. So we said earlier that, number one, she's an executive, which is problematic. Number two, she is related to the CEO, which creates independence problems for her. But now we've also seen that she's actually a shareholder of Angela's, which also creates independence issues for her. So you now have 3 points to discuss with just that one principle that speaks to the fact that the chairperson of the board needs to be an independent non-executive director. Now, getting into this part about the properties, right? What are the issues here? So the issue is definitely Section 75 of the Companies Act. So this is the director's personal financial interest, and it's very problematic because it does not seem like they actually disclosed this interest. Now there's a whole lot of steps in Section 75 about the fact that they need to disclose this interest. They should not be voting on these issues and so on and so forth. From the context that we've just been given here, it doesn't sound like Angela and her father have disclosed this matter to the other members of the board. And it also doesn't sound like the matter has been minuted, because then the auditors also haven't picked that up. And if it had been minuted, perhaps the auditors would have at least picked that information up when they were reading the minutes of the board meetings. So that is very problematic. Another thing that's potentially problematic is the fact that Angela considers accounting rules to be very silly, which means that she has absolutely no respect for IFRS as a concept or for fair financial reporting, which creates issues for us in terms of Section 29 of the Companies Act, which actually requires that the board of directors take responsibility for fair financial reporting, basically, to make sure that their financial statements are not misleading in any way. And this is not the case here. So this is how you ought to be thinking or writing these things, right? So you read through the information, you think about what section this information potentially triggers, and then speak or write about the application thereof. Now we move on to the next one. So she still says, for example, it's best not to reveal too much about our other assets, and the reason why she says this is she says that there are charities that keep calling asking for money, and the fact that SARS thinks it's their obligation to audit my tax affairs every 12 months. So I think if we just stop there a little bit, right? So if we just think about her feelings about donating money to charity, that tells us a lot about the ethical culture at Angela's. So their feelings towards donating money to charities. It speaks to personal business ethics, which is going to be my next video, or the fact that she also doesn't want them to reveal too much about their assets. Speak to the fact that they don't have a culture of transparency, so they're not interested in being transparent, in reporting accurately and fairly to their stakeholders. And if we go back to what I mentioned in my first video about having a stakeholder inclusive approach, it doesn't quite seem like that based on these words that we've just read. Now let's see what else comes up. She also speaks about the fact that SARS keeps, thinks it's their obligation to audit her tax affairs every 12 months. Now, if SARS is auditing you, chances are the math is not mathing. So your returns just aren't making sense, which then tells us a lot about Angela's integrity in this particular instance. So is she a person that is honest? Does she have integrity? Why does SARS feel the need to audit her literally every year? It just doesn't make any sense. Okay, then she says, anyway, I was thinking perhaps we should buy a property in Camps Bay and custom develop a boutique of hotel and restaurants we open next year. Then she says the total cost is that it would be a great investment. And she says this will have the potential to provide our security to our family for generations to come. Now, this is very problematic if you just think about Section 76 of the Companies Act. So Section 76 of the Companies Act says that directors are to act in the best interest of the company. And this is also something that Principle 1 of King states, right? So when you are a director, your number one priority should be the company which you serve. Now, it looks like Angela's priority here is to her family and creating generational wealth. So this now creates potential issues in terms of 76, that she's also using her relationship or is using her position as a director to unduly benefit at Angela's, the company's expense, which is actually inappropriate. Then she says, I was happy to see that Angela's has not been mentioned in the papers despite the company's meat supplier being included in those slandering articles about the donkey and horse meat scandal. Then she says we should ignore this issue because it will blow over. She says that selecting a new supplier would push their costs up. And she says that the rest of the board members haven't read this articles yet because no one has made mention of it. Now, if we think about what I mentioned about King and the fact that it encourages a stakeholder inclusive approach, they are now here with issues of a supplier who has had a scandal of supplying donkey and horse meat. They want to ignore the issue instead of addressing it with their stakeholders. So it could potentially result in potential harm. Again, speaks to business ethics because as a company, is the company honest to consumers? Are they a responsible corporate citizen when they're lying to their customers and so on and so forth? We could also think about Section 22 as well in this case because they may be trading recklessly. We could also think about Section 76 with this particular issue because it would create reputational damage if this were to come out. And the company could be sued or potentially be forced to close down as a result. So again, Section 76, this would not be the directors acting in the best interest of the company. And the fact that the other directors have not heard about this does not prevent Angela and her father from coming clean to their fellow directors and telling them this so that they can actually make good decisions for the company, because the company should come first at the end of the day. So in summary, think of Section 22, Section 76, think of Principle 8, think of Principle 16, all of which speak to the fact that we need to consider our stakeholders. Angela then says, please don't discuss any of these matters with Gordon. It is best to leave him in the dark. He is a huge asset to the company. But unfortunately, he's a goody two-shoes, right? And he's all about abiding by rules and acting ethically. Then he says, luckily, the rest of the board are pushovers. Right? So why is this statement problematic, or is it problematic? It is problematic in that being seen as a abiding by the rules and acting ethically gets you the nickname of being Mr. Goody Two-Shoes. Also problematic in that Angela suggests that the other board members are pushovers. This would mean that Angela or both her and her father have a very autocratic style when it comes to being members of the board. So they're domineering, and other directors are just not free to express their opinions, which then becomes a problem because if you're going to be a pushover, you don't bring that independence that's required to the board. So in summary, the issue here is that Angela seems to be a very autocratic kind of leader. And the other issue is that the other board members, if it's true what is being said here, that they are pushovers, potentially creates issues around their independence. Do they feel free to contribute towards good corporate governance at this company, or are they just there to collect their money and then call it a day? That was that question. Just scroll through to the required. So we'll be looking at part D, right? So part D says, based on the information provided, discuss 8 corporate governance concerns regarding the first group and the conduct of its directors. So I just wanted to highlight the fact that this part here wasn't really necessary, right? So the examiner could have left this out completely, and the expectation would have been that you would have needed to discuss both the King as well as the Companies Act. As soon as they say corporate governance concerns, it usually includes both. If they want you to just discuss the Companies Act only or the King 4 only, they will specify. But if they say nothing and just leave it at corporate governance, the expectation is that you need to discuss both. So that was just a quick FYI. So we're told about the fact that this is a group of companies, and then we're given some background with regard to the question. Right, and if we move on to the next part of the question, we're told about Vikesh, who is the CFO of the company, so that's great. Then we're told about the fact that Vikesh was dissatisfied with the services of the previous auditor. He then takes it upon himself to approach a new firm of auditors and gives them an offer, right? And then it says that he specifically requests that this person needs to be the engagement partner, and that person also happens to be his brother-in-law. So if you're already thinking CPC, very problematic, 100% true. But what is the impact on this on corporate governance or on this particular question D? We'll see in a bit. And then we move on to the overview of the leadership and corporate governance structure. So they tell us again that they are listed on the JSE, same as that Unisa question. As soon as you see JSE, then you kind of should know that you need to apply King, the composition of the board, as well as those committees that have been mentioned. You should already be thinking about the King principle that speaks to the fact that majority of the board needs to be non-executive directors, which seems to be the case, right? So you see that there's more non-executive than there is executive members, which is good. But we also want to see that majority of these non-executives here are actually independent. We're going to see if that is the case when we then read through further. Okay, so it says here that Leon is one of the co-founders of First Group and plays a critical role as chairman of the board. His presence is invaluable, and he has provided continuity, leadership, and experience within the company for 15 years as a chairman. He is still a significant shareholder who has the wellness of First Group at heart. Now, similar to that Unisa question that we just did, right, we will realize that if he's a significant shareholder, it already creates problems in terms of his independence. So we already are concerned about the fact that about his independence. It also mentioned here that he has been a chairperson for 15 years. That independence then comes into question if you have been serving for more than 9 years. So again, this already puts his independence into question, over and above the fact that he's a shareholder. All right, and then it says here that the former CEO retired towards the end of 2019 and was replaced by Mandla, who is Leon's son-in-law. Very similar to that Unisa question, actually, now that I think about it. So here we see that the chairperson is related to the CEO, which creates a conflict of interest for the CEO. Then it says that Christina, who is the member of an audit committee, so it says that Christina, the former director, was a former director of strategy. And when she resigned from her executive position, she was appointed as a non-executive director and member of the audit committee on that date. And so the issue here is that Christina is a member of the audit committee. Now we know that all members of the audit committee have to be independent non-executive director. Now we know she's already a non-executive, which is great, but is she independent? She's not independent because she was literally an executive just before she became a non-executive. So the King Code speaks of a period of 3 years, which she doesn't have. And so because she doesn't have that 3 years, it now means that she's effectively not an independent non-executive director, which means that she has no business being in the audit committee. Then it says both Mandla and Adam have risen through the ranks, so first grow prior to their appointment to their current positions. Okay, that's fine. Then it says Cyril is the lead independent non-exec to support the chairman of the board. Cyril is a representative of one of First Grow's subsidiaries, and he also serves as a non-executive director of the subsidiary's governing body. So a good thing is that King requires that there be a lead independent non-executive director. It would especially be beneficial in this instance because we've established that the chairperson of the board is not independent at all. But the question is this person independent? The answer is no. So they're not independent because it says there that they are a representative of one of First Grow's subsidiaries as a member of the board, albeit in a non-executive capacity of a subsidiary. So this also tells us that this person is not independent. So in summary, right, in terms of the independence, we were happy that majority of the board members were actually non-execs. But we are now subsequently a bit unsure about whether majority of them are actually independent, or rather whether majority of the non-executive directors are independent. Because Leon Kulula, chairperson of the board, was not independent. Christina, we said, was not independent. Cyril, we said, is not independent. We have 4 of the 7 non-executive directors being independent, which is actually a good thing. Let's see if we're going to find additional information further down the scenario that might disprove this. Okay, so with the last point, it says that they have all the other committees that are required by JST listing requirements, came for reports in the Companies Act, so that's great. So in terms of subcommittees, they fully complied, and therefore there are no concerns with regard to this. All right, and then this issue here, it speaks about the fact that the chairperson of the board had received a copy of a JSE proactive monitoring report, and they were particularly concerned about how certain items had been accounted for in the cash flow statement, and that the JSE actually required First Grow to respond. So what then happened is that there was a suggestion that there needs to be a response to the JSE. The CFO did not support what the chairperson had suggested because he felt that it undermined his competence. So we see we have an ego problem there. And then he then says something to the tune of the fact that he would ask Ronald being the audit partner, for assistance to resolve this matter with the JSE. And then it says that none of the other board members raised any issues with regard to this matter, and at the CFO insistence, it was resolved that the CFO's proposals be implemented. Now, similar to what happened in the Unisa question, you now have an instance where one person is literally dominating the discussions and the decision making, and they're insisting that their way is the right way. You also have issues with regard to board members that feel the need to keep quiet and not voice their concerns, which creates issues for us because why are you there, right? Which creates issues because why are you there? If you're not going to voice your opinion when you see that something's wrong or that something's not 100% okay, you're actually avoiding your responsibility as a member of the board, which is very problematic. So the discussion here would be around that, the fact that the CFO is domineering, none of the board members, they seem to just ignore their responsibilities altogether, which is very problematic. And we might also have a Section 29 issue of the Companies Act, in that there are issues with regard to accounting. And so if there are accounting issues, which speaks to the fact that there isn't fair financial reporting. So here they speak about a loan, so that actually relates to another question, so we're not going to go into that. But the issue here was that the CFO did say that the group has been able to meet all their loan covenant requirements with regards to 2019, and then he added that 2020 hadn't yet been finalized. Then says here that the board said that they would, the CFO needed to provide feedback at their next board meeting. Matter 3 then speaks of financial challenges that are being experienced by the first row group. So as soon as you see financial challenges, you should be thinking about Section 22 at the back of your mind. Let's see if that's something that is actually relevant in this particular instance. So they speak about the fact that they've negotiated with a bank, and that the bank had agreed that they were going to extend the repayment period of a loan for another 2 years. And because of this extension, the group's ability to meet its cash flow requirements would actually be improved. One thing to think about, so I had said you must be thinking Section 22, that is something that you definitely need to be thinking about now, because if they say that the group's ability to meet their cash flow requirements actually rested on them renegotiating this loan, speaks to potential going concern issues, which may speak to Section 22 that deals with reckless trading. So that's something that you could potentially bring in as part of your discussion as a concern. And then we get to this email. So we now have the chairman of the audit committee writing an email to the auditors. There was a meeting where the CFO had taken responsibility to hand over a response with regard to the JSE report, but he's not aware of any progress, and he's getting rather worried. As far as I know, no response has been provided to JSE yet, and I don't think any amendments have been made to financial year 2020 draft AFS. Says what frustrates him is that the CEO never voices his opinion. In the board meeting, he didn't even respond to the CFO's refusal to establish a task team. So that's something that we'd already raised up top, to say that it seems that the other members of the board are just there. They don't voice out their concerns, which is very problematic, and they essentially allow the other members of the board to dominate them. Right, so this potentially creates certain issues with regard to the audit committee specifically, right? So the audit committee essentially has responsibilities relating to all issues audit and issues relating to fair financial reporting in general. So they oversee that aspect of how a company operates. Now you'll recall at the beginning of the question we said that Vikesh had actually gone and appointed the auditors himself. Very problematic, because that is not how appointment of auditors happens. It's actually a company, so the procedure is actually a Companies Act requirement. And it was also problematic that the audit committee was not involved in that decision, because they essentially need to oversee that. They need to oversee, for example, the amount that is charged for audit services. It mentioned in the question that Vikesh had actually gone to the audit partner or to that audit firm with an offer about how much they were to charge, right? Very problematic. Which was related to the audit partner. That is something that the audit committee needed to oversee. It seems from this that the CFO seems to be running the show. The audit committee is just there, like in the background, not really doing what they need to be doing. It's also problematic that the JSE would raise issues regarding to the integrity of the numbers in the financial statements when, that is essentially the responsibility of the audit committee in terms of oversight as well. Let's see what other issues the audit committee is raising. So it says that I have another issue because earlier this week, what happened was that we got partly completed AFs, which was submitted by the CFO. So the issue with this is that if they get partly completed AFs, then they're not able to review the AFs to ensure that the integrity of those numbers that have been reported. And actually says that they refused this, or rather they received this 2 hours before the meeting had started, which again speaks to how problematic their relationship with the CFO is in particular. And then also says that he was upset that Nathan rushed to finish the meeting as he had a golf and lunch appointment with his longtime friend Vikesh, our CFO. Nathan Pillay, if we just go back to the list of the board of directors. So Nathan Pillay is this guy. We did not have any additional notes relating to him, and so because there was no additional note relating to him, we'd actually judged him to be independent. But now, based on that comment that has now been highlighted for us, that he's actually a very good friend with the CFO. They even play golf together, right? And so because they play golf together and they're quite familiar, it speaks to, will Nathan be able to independently give advice and oversight over the operations of this company? It is highly unlikely. This therefore brings Nathan's independence into question, and because of this, then you have the situation where it's only 3 of the 7 that are actually independent, which is contrary to the suggestion of King. So that is something that you then need to discuss. Okay, then says, as far as the DBSA loan covenant requirements are concerned, there seems to be haunting the financial guys since 2019. Then they're going to give some background about what happened, but it actually says here that the CFO had actually stated that he'd make sure that the loan covenant requirements are met to prevent the DBSA from demanding repayment due to breached loan covenants. And then he says that he's relieved but very surprised, right, at the fact that he says that the loan covenant requirements have again been met. So this speaks to, the integrity of the CFO, especially as it relates to financial reporting. Is he manufacturing numbers, engaging in creative accounting, so accounting for things that aren't there, to make the situation look better than it already does? It sure seems like it. And then if we look at the fact that all of these issues, so you have an issue where the JSE is identifying issues with regard to the integrity of the financial information. You have instances where the issues regarding to how the JSE report is to be handled is now delegated to the CFO as opposed to the audit committee themselves, and this is in accordance with section 94.7G. This brings into question the competence of the audit committee. So do they have the right skill set? Because King requires that they need to be financially literate. So it's concerning because I'm not seeing the financial literacy coming through with regard to how many issues have been identified. And the environment is also not conducive to them doing their work properly because they're getting information very late. Which brings to question, are they effective? Are they actually discharging their responsibilities as required? It doesn't seem that way, and that is definitely an issue here. That's the end of the scenario as it relates to the question that we're trying to answer. Now, if we just go back and see if we've missed anything or if there's anything else that we can perhaps add, right? So if we think about, for example, section 76, would you be able to say that the board of directors as a collective is acting in the best interest of the company? Highly unlikely, doesn't seem like it. And given the fact that there's so many non-compliance that we've identified as it relates to, say, the Companies Act, that brings into question Principle 13, which requires that the company actually comply with all laws, regulations, and codes. I always used to tell my students to discuss Principle 1, 3, 13. I think another one is potentially Principle 10. So Principle 1, which speaks to the fact that the company has to, or the board has to lead ethically, right? In this particular question, you were told specifically to ignore Principle 1. So it would not be applicable here, but would be applicable to, say, the Unisa question that we just did, where you mention that requirement and then you go and you find something from the scenario to apply with regard to that specific requirement. You would speak about Principle 3, which speaks about the fact that the company must be seen to be a responsible corporate citizen. You can then go and pull information from the scenario that you could apply to that. So things that deal with like certain non-compliance issues, potentially apply it to this, because a good citizen will abide by the laws of the country, and that would also be applicable to corporates. I would then speak about Principle 13 because, again, it's also one of those umbrella principles that speaks and can be applied to any form of non-compliance. And usually if you're dealing with a concerns question, you're bound to find non-compliance issues, so it would just make a lot of sense to incorporate Principle 13. Principle 10 speaks to the fact that companies need to source advice on how to handle matters of corporate governance. So they would ideally appoint a company secretary. Now, as soon as you see that there is multiple issues of non-compliance, you want to question whether or not they are actually getting this advice. And this is also a Companies Act requirement as well, Section 86, which says that they need to appoint a company secretary and sets out the roles and responsibility of a company secretary. And so the minute you see that there's non-compliance, it then brings into question whether or not they are getting sound advice from such a person. Also discussion in Section 76. It's just one of those really nice principles where you can bring in anything really. So if you see something you're like, it kind of looks wrong, but not too sure how I can apply it or what I can write, which principle I can link it to, I think 76 might be your best bet because it's quite broad. So just find one of those sub requirements in there that could potentially apply, and then make sure to apply that using the given information. And then Section 77 would then stem from your inability to apply Section 76 and any other section where Section 77 is applicable, that might be evident from the question. So in the Unisa question, remember that there was a director's personal financial interest issue. So what that Section 75 actually says is that if directors don't act according to that section, they may find themselves being personally liable. So I think the section on personal liability is actually a very good section to bring in to just tie everything together. And I think that's that, guys. Do let me know in the comments or by email how you found this exercise, and if there's anything in particular that you want me to touch on that relates to corporate governance.